Each month, REIT.com will sit down with Green Street advisors to get their take on the real estate investment market. Today I'm joined by Green Street Chairman and Director of Research, Mike Kirby. Mike, Green Street's CPPI shows commercial real estate values bottomed in May and have trended up since then. However, Moody's CPPI is still showing that prices are declining sharply. What accounts for that radical difference?
Well, it's the nature of the two indices, really. Moody's certainly has a good time series historically, and the way they construct their index makes a great deal of sense. The biggest flaw with it, though, is it's a transactions-based index. And as anybody in the real estate industry knows, there's a pretty sizable lag between the time that a handshake occurs on a real estate transaction and the time that it actually closes and gets reported. And so Moody's is forced, with their transactions-based index, to look at those closed deals, which typically lag when the handshake took place by 3, 4, 5, 6 months. Our index, which is based off of our longstanding NAV time series, what we're really trying to do when we calculate NAV is capture where handshakes are occurring today or are likely to occur in the coming month. And it allows us to react much quicker. To me, anybody that just attended the recent NAREIT conference would have the same opinion that real estate values have ticked up in the last several months.
The rapid growth in Green Street's price index over the past 6 months seems to offer hope for avoiding a commercial real estate meltdown that's based on the approaching wave of debt maturities that can't be refinanced because of the declining property values. Now, do you feel that property values will be able to recover fast enough to permit most of this debt to be refinanced?
No, the problem is still huge. Anybody who bought a property back in the 05 through 07 time period probably owns something that's worth nothing today, more often than not. So there is a lot of blood in the streets. It's just what's now become obvious is that we're going to have a fairly orderly process that's going to take place to clear the problem. And so as that happens, the pretend and extend program the banks are using probably pushes the problems out 3, 4, 5 years, presumably allows the economy to get a bit stronger. The good news is, I mean, we believe real estate is down. We think it went down nearly 40% peak to trough. We think it's down about 33% today. We think to be priced fairly versus corporate bonds and other capital market benchmarks, it has another 5 to 10% rise that we could easily see take place in the next year or two. We need capital to fill what is a massive capital void. I think that will happen. Capital does a good job of finding attractive opportunities when the market's allowed to work, and we're seeing that happen. So we think there's quite a bit of upside in real estate pricing today. So if by the time the banks are forced to deal with these problems, we're really off only 25%, I mean, that sounds awful. But if that's the drop from 07, it means the drop from 05 is nowhere near as bad. And the banks probably have a loan that has a collateral that's worth at least as much as the loan, and the problems are not as bad as we had feared.
How long will banks' pretend and extend policies have to go on before prices rise enough to permit the refinancing market to function normally?
It's clear that pretend and extend is going to be the order of the day. I think the biggest threat to pretend and extend is the potential for higher interest rates coming, say, a year or two down the road as the Fed starts to ratchet upward. One thing that's keeping a lot of loans alive today is the fact that LIBOR is effectively bouncing around zero, and some of these loans have an interest rate that's not too far above zero. So despite the poor performance by the properties, they're still able to service their debt. That could certainly be a source of problems. It will be a source of problems in some sectors, particularly hotels, the sectors where you have volatile NOI streams. We're going to see the problem surface sooner rather than later. It could well be that problems will not be as pronounced for quite some time, though, in the sectors where NOI volatility is low because they have long-term leases.
Much of the discussion in the REIT industry lately has been when well-capitalized REITs will be able to take advantage of acquisition opportunities. And some are saying this may not happen until 2011 or even beyond. If the rate of price increases that you've seen over the last 6 months continues, will REITs be robbed of much of this distressed buying opportunity?
Well, there was certainly a school of thought a few months back that distress was going to be rampant and the REITs were going to be able to take advantage of distress. But as a theme for the industry, I don't think distress is going to be rampant. That's the bad news. The good news is, as I said earlier, I do believe real estate is cheap relative in terms of the total returns it currently offers relative to bonds, let's say. And I expect that to continue because the major financing markets for real estate are messed up, meaning the mortgage market, will probably be messed up for quite some time. So I think real estate will be attractively priced for 2 or 3 years, and I believe that'll be the state of affairs in the private real estate market. Public market doesn't much care about that. We don't, as stock investors, we don't care what mortgage investors are doing, and so I believe REITs will be trading much more richly. I think that real estate will be priced much more richly on Wall Street than on Main Street. And that creates a wonderful opportunity for REITs to grow, not at a terribly aggressive pace, but it does allow them to issue equity and buy real estate, which I think will be the order of the day in the coming 2 or 3 years.
Mike, in your latest Heard on the Beach report, you said that the rebound in property values has occurred quicker than we would have thought likely a few months back. You also said that monetary and fiscal policies are causing substantial inflation in dollar-denominated asset values across the globe, which includes real estate. This sounds like it could be a recipe for another commercial real estate pricing bubble. Do you think that's where we're headed?
I wouldn't rule it out. When I say real estate is cheap, I say it's cheap relative to everything else. And the primary benchmark I'm looking at is I believe it's cheap relative to bonds. We've seen bond prices rally immensely. We have the BAA rate, which if you take out the year 2005, BAA bonds are at the lowest interest rates they've been at since LBJ was our president. Is that a bubble? I don't know. It certainly could be. There's certainly a risk that all risk assets are now being inflated. And if that is a bubble on a global scale, then real estate could certainly find itself in the middle of that. It's clearly a risk with the policies we're pursuing right now.
Thanks, Mike. We look forward to hearing from Green Street next month. For REIT.com, I'm Matt Bichardt.